Welcome back friends to the class number 91, and in this video we will discuss the key features of Pre-Shipment Packing Credit Facility. So Pre-Shipment Packing Credit Facility, we call it EPC and PCFC as well. Whenever someone tell you that client wants packing credit facility, then by default it means Pre-Shipment Packing Credit Facility only. So EPC, Export Packing Credit, and PCFC, which would mean packing credit in foreign currency. Both facilities are same. EPC is in INR, Indian currency, and PCFC is in foreign currency, which can be euro, dollars, pounds, any currency you want, right? So what is the purpose of pre-shipment packing credit facility that I have already told you in my previous videos, in the concept based videos, that this is a working capital finance needed for export for pre-shipment period from the date of receipt of export orders and to the date of actual shipment of goods. So whatever expenses that are incurred during this period to manufacture those export goods, to transport those export goods to the port, right? Every kind of expenses that are incurred, this facility provides financing for those expenditures. So what is the maximum tenure allowed for this facility? So this facility tenure is based on your cycle from the date of export order receipt to the date of export of goods, or you can say to the date of generation of bill of lading, right? So it depends upon the cycle of different manufacturers, different MSME units, but generally the maximum tenure goes up to 180 days only. The bankers generally don't allow more than 180 days packing credit facility. So which is rightly done by the bankers, because from the date of receipt of orders to the date of only shipment of goods, it should not take more than 6 months to do that process only, right? So generally up to 180 days, a maximum 180 days, but it is subject to your actual working capital cycle. If your actual cycle is around 90 days or 120 days, then no bank will allow the packing credit facility for 180 days to you, right? So this facility is repayable on demand like CC and OD facility, and the bankers can ask for prepayment of this facility amount, this loan amount, at any time by sending a notice to you, which is not done practically though, but this can be done by the bankers, right? So the facility is valid for 12 months period. So the tenure which I have written is different from that 12 months period. The tenure is the due date of repayment of that facility. So if you have export orders of $10,000, say, right? So you have taken the packing credit facility for that, right? So that export order, the packing credit facility of $10,000 which you have taken against your export should be paid back in 6 months. Should be paid back in 6 months period, right? So this 12 months is the total validity period of the facility. After 12 months, after expiry of 12 months, your facility will expire. You will not able to use that facility unless you get it renewed, like CC and OD facility, which need to be renewed after every 1 year. So this facility also has to be renewed after every 1 year. So whether drawing power is applicable? No, the drawing power is not applicable on packing credit facility, but it has indirect impact on drawing power if you have taken CC limit also. So if as a borrower you have taken CC limit and packing credit limit, then although the packing drawing power is not applicable on packing credit, but indirect impact will be there on your CC limit. Why? Because when you calculate drawing power, you take stock, you take debtors, you take creditors, right? So your CC limit to buy stock, to finance debtors, to pay off creditors. You have taken packing credit limit also to finance that stock, right? So whenever you submit your stock statement, you show the stock amount of, say, rupees $1,000. Suppose you are showing the stock of $1,000. Now that $1,000 cannot be bifurcated between stock financed from CC and stock financed from packing credit. So what will bank do? Suppose your debtors are zero, creditors are zero, right? So $1,000 is your total investment, and your DP is 75%, in other words $750. The banks will reduce the utilization of packing credit facility here. Suppose your packing credit facility is used to up to $200, so your net DP will be $550, right? So indirect impact of packing credit facility will be there. But if your business, if you are as a borrower have taken only packing credit facility in your business, there is no CC limit, or you have taken only OD limit, then there will be no implication of drawing power in your business, right? So repayment, how this is repaid? This is repaid from your export proceeds. Obviously, this is given to you to manage your exports, to handle your exports. Whatever payment you receive from your exports will be used to pay off this facility. Disbursement. Now, when this facility is disbursed, in order to get the disbursement, you have to provide the confirmed export order proof to the bankers. The bankers should get the export order proof from you so that they can know that you have received the export order from foreign parties, and on the basis of that confirmed export orders, the banks will release you the packing credit amount, right? After deducting the margin. The margin can vary from 10 to 25%. Suppose you have received the dollar of $10,000. If your margin is 10%, the bankers will release $9,000 to you in shape of pre-shipment packing credit facility. $1,000, the balance, the difference between them, you have to manage from your own sources, right? So the disbursement of packing credit facility can be running based and order based. Now, what does that mean? So suppose you have received 5 orders, one order of $10,000, one order of suppose $5,000, one order of $8,000, one order of $6,000, one order of $4,000. You have received 5 orders. So you have requested the bank to release you the packing credit amount to process these orders, right? So suppose the margin is 10%, right? So if the packing credit is order based, then what will happen? For each order, bank will track each order separately. For $10,000, bank will release you $9,000, $4,500, $7,200, $5,400, $3,600. So this amount will be released by the bankers to you for each of this order, right? So separate tracking code will be opened for each of the order. And when you receive the payment, right? So suppose this order was from David, this was from suppose somebody else, suppose Nathan, right? So if you have received payment from Nathan, then that payment from Nathan cannot be used to pay off the liability of David, because it is being tracked separately. Any payment received from Nathan will be used to knock off the dues of this disbursement only. So this is pure order based tracking, which is very a very hard tracking. Each order is tracked separately by the bankers. But running based, which is very obviously beneficial for the borrower, this is just like CC limit. So suppose you have taken 5 disbursement and packing credit account will be opened for you. So all these 5 disbursement of $10,000, right? 5, 8, 6, 4 will be debited, and this will be your total outstanding, like you use CC limit, right? So whenever you have received the payment, either from Nathan, from David, or from anybody else, right? That payment will be credited here. So suppose you have received $12,000. So the $12,000 payment will be credited here. It will not be matched or tracked to any specific order, right? So all the orders will be shown in one limit account only, like CC account, right? Here all orders have unique tracker number, right? But in this, there is no separate track record for each order. All the orders will be shown in one account only. Whatever payment you have received will be knocked off on FIFO basis. FIFO basis means first in, first out, which would mean the $12,000, first the old bill will be assumed that it is being paid off. So $12,000, the bank will assume that $10,000 is being paid off. It could happen that $12,000 has been paid by them only, but the bankers in running limit will not track each of the party. They will take the $12,000 payment and they will adjust these $10,000 dues first. Then the balance $2,000 will be adjusted against that $5,000 amount, and the payments of these amounts will remain outstanding. So it will keep on running like this, just like CC and OD account. So there are two methods of operating this account. So what is the security? So this is given to this facility is given for your working capital purpose. So first charge on your current assets is mandatorily taken, and collateral security of land and building is also taken by the bankers. So stock statement is generally not mandatory in this facility, but some banks ask for the stock statement, but generally it is not mandatory. Comfort level of bankers are very high because it is tracking based limit. You get the export order, you confirmed order basis that you are given the limit, you are doing the export, you are doing good thing for the country, and if the order based facility is there, each order is tracked, right? So comfort level of the bankers in this facility is relatively high. So how this facility is assessed? This facility is assessed basis your working capital cycle, that from the date of receipt of order to the date of export, and MPBF method is also applied by the bankers for assessment of the limits. So dual methods are followed for this assessment, and that method will be taught to you in a separate video by me in upcoming lectures. So stay tuned with this channel. Thank you very much.